Good evening, friends. Good evening, friends. Very warm welcome to this CTC lecture meeting on analysis of Mumbai ITAT ruling in case of Sky High Leasing. Friends, this is one of the most important ruling from an international tax perspective in recent times. We all know that India signed the MLI instrument in June 2017. It was signed by the Honorable Finance Minister at Paris. Thereafter, India deposited, the instrument with OECD in on 25th June 2019. As a result of which, MLI came into force with respect to Indian DTAs. India also issued a notification on 9th August 2019, and India has also issued, the what you call the covered tax agreement or the changes to the covered tax agreement separately under certain DTAs, not all the DTAs. And I think the assumption was, or the interpretation was, that the MLI has come into force, or the agreement has become a covered tax agreement with the ratification by the other country as well. But now we have this very interesting ruling of the Mumbai ITAT in case of Sky High, which has followed the Supreme Court decision in Nestle to say that a separate notification is warranted for the MLI changes to be read into the treaty, especially the principal purpose test. And it's important for us to understand the impact of this ruling, the correctness of this ruling, and the way forward for the several covered tax agreement, which otherwise we are using in our day-to-day life and practice. And we could not have asked for a better speaker than CA Himanshu Parekh and our very own committee member, CA Monica Vadani. I welcome you all to this lecture, and I hand it over to Chaitanya to introduce the speakers and thereafter hand it over to the speakers for the session. Thank you. Chaitanya, over to you. Chaitanya, you are on mute.
Thank you. Thanks a lot for briefing of the session topic, Shabir Bhai. So today we are pleased to have Himanshu Parekh, and another versatile with him, a versatile personality, another one. So Monica Vadani. So to start with Himanshu Bhai, it's pleasure to uh, introduce a professional having such almost more than 2.5 decades of experience, and who is a member of Chartered Account ICIs, in, cost accountants, and and also a CS. So he is partner and head corporate and international tax KPMG. He has extensive experience on cross-border tax issues and investment structuring, both inbound and outbound, and has advised multinationals on complex tax issues and helped clients in developing appropriate strategies for tax planning and restructuring. He has also helped clients successfully navigate through complex litigations and evolve alternate dispute resolution strategies. So, along with this, he specializes in technology, media, and entertainment and telecommunications sector. So he's a regular speaker at various forums like CTC, BCS, and uh, has contributed several articles, papers in professional journals, newspapers across. So I welcome Himanshu sir to the CTC forum. And next speaker we have Monica Vadani, who is technical director with KPMG, having almost 2 decades of experience. Uh, and she has advised various multinationals on variety of tax and regulatory matters with special focus on international tax, exchange control, and company law perspective. She has advised also clients in inbound and outbound structuring, complex corporate structuring, including mergers and acquisition, demergers, capital and debt structuring, tax planning, equalization levy, etc. And she is a member of International Tax Committee of Bombay Chartered Accountants Society, as well as the convener of the Chamber of Tax Consultant International Tax Committee, CTC, and along with that, convener of BEPS Study Circle of BCS. So She has done in-depth analysis of BEPS action reports and the multinational instruments, and has contributed a chapter on overview of MLI and each of its 17 articles as part of MLI compendium of BCS. She has contributed chapter on most MFN clause part of CTC's International Tax Compendium. She has also various other papers and articles on tax and regulatory issues and regular faculty at various forums like ICI, CTC, BCS, etc. So with this introduction, I welcome you both, Himanshu sir, a prolific speaker and uh, faculty for today's topic, and Monica Vadani. So welcome both of you. You yes, you can continue,
Thank you,
sir,
Chaitanya,
with the
Ivanshu
session.
bhai, Monica, over to you. Thank you so much.
Thank you.
Thank
Thank you
Thanks,
so
thanks.
much. First and foremost, many thanks for those kind words of introduction, and a big thank you to the Chamber for inviting Monica and me to share our thoughts on this recent decision of the Mumbai ITAT in the case of Sky High Leasing. Now, as Shabbir pointed out earlier in his opening remarks, this is a very important decision and is going to have significant ramifications on the interpretation of tax treaties going forward. This decision deals with several aspects involving interpretation of tax treaties. First and foremost, about the role of multilateral instrument and the effect of multilateral instrument or MLI when it comes to interpretation of tax treaties. Secondly, uh, the interpretation of the principal purpose test, which is now enshrined into various tax treaties. Thirdly, the character of income earned by the taxpayer in this case, which is income earned from leasing of aircrafts, whether that would amount to royalty or not. And lastly, if the income amounts to business income, should it be subject to tax under Article 7 of the tax treaty, or should it be subject to tax under Article 8 of the tax treaty, which deals with taxation of income arising from international operations involving aircrafts. So these are the four aspects which have been dealt with by the tribunal in this landmark decision. Basis the discussions that we've had with Shabir on the subject matter, what we propose to do in the session today is to focus on the first two aspects of this decision, which is the role and impact of MLI and does it seek and how does it impact the India-Ireland Treaty. And number two, the interpretation governing principal purpose test under the India-Ireland Treaty having regard to the facts of the case. Now, if we look at the genesis to the MLI, the genesis to the MLI is to be found uh, in the BEPS project, which was initiated by the OECD way back in 2013. Yeah, if you can go to the next slide, please. So the genesis to be found in the BEPS project, which was initiated by the OECD way back in 2013. What was the objective behind the BEPS project? The objective behind the BEPS project was to come up with measures to counter base erosion and profit shifting exercises or means being adopted by multinationals globally. As a result of the BEPS project, the OECD came up with several action plans to introduce measures to counter base erosion and profit shifting strategies being adopted by taxpayers. Now, having come up with these action plans and the so-called recommendations to deal with BEPS, it was then necessary to incorporate all those recommendations arising from those action plans into the tax treaties which have been entered into by several countries globally. Now, globally, there are more than 3,000 tax treaties which have been entered into between different countries. And if one tried to incorporate the recommendations of the BEPS action plans into the respective treaties by bilaterally modifying each and every treaty, that would have taken multiple years or maybe even decades. And as a result of which, the OECD came up with this novel concept of MLI, which ensured modification of all the tax treaties across the globe at one go. Now, the way this modification was done was that every country which was a signatory to the MLI was supposed to provide the OECD with a list of all the tax treaties which it intended to be modified by MLI. So if, for example, India has entered into more than 90 odd tax treaties with its treaty partners, India was supposed to provide with a list of all those treaties out of the 90 odd treaties, which are the countries where we want our treaty to be modified by MLI. We were supposed to provide a list of those treaties, and that is something known as covered tax agreement. And while indicating or providing the list of those treaties which we intended to modify, we were also supposed to notify the OECD about certain optional provisions and reservations which we were able to express by incorporating the MLI into the tax treaties. And India did therefore give a list of all the tax treaties which it intended to modify to the OECD. And that list was given after following the due ratification process in India. The ratification was pursuant to the parliament approval, and pursuant to that approval, the ratification was done. And after that, India provided the list of covered tax agreements to OECD, along with the list of optional provisions and reservations on different articles of the MLI. Now, the one question which comes up for consideration is, how exactly does a MLI impact an existing tax treaty? So if we see the explanatory statement to the MLI, what the OECD clarifies therein is that, number one, MLI does not amend an existing tax treaty, but it is supposed to be read alongside an existing tax treaty. It does not replace an existing tax treaty. It only modifies the scope of an existing tax treaty. Further, if there are any terms which have not been defined in MLI, they shall carry the same meaning as they have in the respective covered tax agreement or the tax treaty which has already been entered into. And how are the provisions of MLI to be interpreted? The OECD has clarified that the provisions of MLI are to be interpreted in accordance with the ordinary principles of treaty interpretation. So this is just to give you a quick overview of the concept of MLI. And given that this particular aspect is going to be extremely important in the course of our discussion today, we would like to spend some more time in terms of which are the list of, first and foremost, which are the articles of the MLI which will impact existing tax treaties, which are the countries which India has notified where it wants MLI to amend those tax treaties, and what will be the impact of the MLI on existing tax treaties. And given that Monica has done a lot of work in this particular area or sphere, I'm going to request Monica to step in now to provide us with a little better overview of the impact of MLI on tax treaties. And thereafter, I'll again come in to discuss about the specific details of the ITAT decision. So, Monica, over to you now.
Thank you, Himanshu. At the outset, thank you to Chamber of Tax Consultants, International Tax Committee, for providing me with this opportunity to present my thoughts on this ruling and also on the evolution of MLI. So, as we heard, the genesis of MLI, which started with EPS action reports, and in 2015, there were total 15 action reports which were published by BPS, OECD. Thereafter, as we saw the journey, in November 2016, more than 100 jurisdictions, including India, in principle agreed with the MLI, and the formal signing ceremony of MLI took place in June 2017, wherein India was one of the signatory to the MLI. Then comes the concept of when does MLI come into force and when does MLI come into effect. So there is MLI Article 34, which explains the provisions how MLI comes into force. So once MLI is adopted by first 5 jurisdictions across the globe, then one have to see that vis-a-vis each country. So for example, for India, when did India deposited its ratified instrument with OECD? And along with that, we have to see when does the other country who is a covered tax agreement with which India has a covered tax agreement, when other country has deposited with OECD, 3 months down the line, whichever is later, 3 months down the line, MLI comes into force. So as far as India is concerned, India has released the press release on MLI, which was approved by the cabinet in June 2019, and thereafter India has deposited its MLI position list of covered tax agreements with OECD on 25th June 2019. So 3 months down the line, for India as a country, MLI comes into force from 1st of October 2019. Now we have to see when does MLI come into effect. So Article 35 of MLI provides the provisions of how do we interpret and read MLI coming into effect. In case of India-Ireland Treaty, one have to see that, when did India deposit? As I said, India deposited its ratified instrument with OECD in June 19. Ireland deposited before India. In fact, Ireland deposited in January 2019. So later in time is India, and therefore the entry into force remains 1st of October 2019. And when it comes to entry into effect, we have to see there are 2 different timelines which are provided, one for the withholding tax provisions and other for other taxes. Coincidentally, for both the provisions for India-Ireland Treaty, MLI comes into effect from India's perspective with effect from 1st of April 2020, that is financial year 2021. And this has been also mentioned in this ruling, and there is no debate as far as the dates are concerned in this ruling. Then we come to the notification of MLI. So what Article 27 of MLI suggests is that paragraph 2, it says that respective countries have to follow its domestic procedures for bringing MLI into effect. And what is the procedure in India? In India, we have to go as per section 90, subsection 1, which requires a notification of a particular treaty or protocol, in this case MLI, which is a multilateral instrument. And accordingly, India has notified its MLI on 9th of August 2019. And we will see the fine prints and the wordings of the notification in the upcoming slides. Just a minute. Yeah. Okay. So then just a minute. I have to mute my audio for 1 second. Yeah, sorry for the interruption. So there are total 7 parts to MLI. Part 1 is a substantive provision which provides what is the scope and how do we interpret MLI. Part 2 is on the hybrid mismatches. Part 3 is on very important provision which is treaty abuse. Part 3 also gives us what is called as MLI Article 6 and MLI Article 7, which deals with preamble and the principal purpose test respectively. So the rows which are highlighted in green over here are the mandatory standards which are to be followed and accepted by all the countries who are signatories to MLI and who are a covered tax agreement. One which are highlighted in orange are the optional provisions, and where India has opted out of that particular respective MLI provision. When we see the further parts to the MLI, especially part 7, This is important. This gives us the final provisions on the signatures, ratifications, acceptance and approval of the MLI process. So we will deal with the notification part in the later slides, as I just mentioned. We have already discussed the provisions on entry into force and entry into effect. All these provisions are very important in order to interpret how a particular existing treaty gets modified by the provisions of MLI. As Himanshu mentioned, MLI does not replace the provisions of existing treaty. We have to read the provisions of MLI alongside the provisions of existing treaty. Now, how do we read that? So there are total 4 different types of compatibility clauses, uh, in light of which we have to read whether the existing provision in the treaty gets completely replaced or whether it gets modified to certain extent, and how does it apply. So those 4 types of compatibility clauses are equally important in understanding the interpretation and applying the provisions of MLI. So now we come to the press release dated 12th of June 2019, which was approved by the cabinet. And if you see the bold highlighted portion, paragraph 5, it reads like this. The convention, that is the MLI, will operate to modify tax treaties between 2 or more parties to the convention. It will not function in the same way as an amending protocol. Now, this is very important, and we will discuss in the upcoming slides that, in Nestle ruling, whether it was a case of an amending protocol which was required to be notified and whether MLI is an amending protocol or not. So, this para 5 of press release itself says that MLI is not an amending protocol. We can also take a recourse to explanatory statement to MLI, para 13 on page number 3, which also says that MLI is not an amending protocol. And in this particular ruling also, there was an argument which was placed wherein it was argued that MLI is not an amending protocol. And why I am emphasizing on this term is that if MLI is not an amending protocol, whether a separate notification, which is the subject matter of our discussion today, is indeed required or not. Thereafter it says that if you read further that, MLI would directly amend the text of the covered tax agreement. Instead, it will be applied alongside the existing tax treaties, modifying their application in order to implement the BEPS measures. It also says, so this also gives the intention of Indian government that it always wanted to implement the MLI since the day it notified the MLI and it deposited its instrument with OECD. If we go to next slide and read the fine prints of the notification, which was brought in on 9th of August 2019, this was in accordance with the provisions of section 90 subsection 1. And again, if we read the bold paragraph, which is paragraph 3 over here, it reads like this, whereas India had ratified the said convention and had deposited the instrument of ratification along with the list of covered tax agreements, reservations and notifications, hereinafter referred to as India's position, to the depository, which is OECD, as in Article 39 of the State Convention. So Article 39 of MLI just says that OECD will be the depository and you have to deposit all your MLI positions, etc. with the OECD. So, and then on the next line, it says that MLI comes into force with effect from 1st of October 2019, which we just discussed a while ago. So, so the importance is on the wordings of the notification, okay, which is rightly ratified and notified as per provisions of section 90 subsection 1. And if we see further in this notification, annexure is also given. So let us read second paragraph of this particular slide, which reads like this. Now, therefore, in exercise of the powers conferred by subsection 1 of section 90 of Income Tax Act, central government hereby notifies that provisions of said convention shall be given effect to in the Union of India in accordance with India's position under the said convention as set out in the annexure hereto. So, the point for deliberation is that in India's position, which is deposited with OECD, India has already given list of all the countries and para-wise which position India wants to take vis-a-vis that particular country, which MLI article India wants to adopt, which MLI article India wants to opt out from, etc. And where India has already notified Ireland, and Ireland has also notified India in their position, which they have deposited with OECD. And our position, India's position, is also forming part of this particular annexure to the notification. Okay, so thing is that vis-a-vis each of the country, what is India's position, that is already forming part of this particular annexure, and that is what is deposited with OECD also. So the question really is that whether India has already done the notification part, which was required as part of section 90 subsection 1, and whether there is indeed any need for India to separately notify its MLI position with each of the country bilaterally once again. That is the question. And when you read the last line of this MLI notification on this slide, it also says that, without the need to bilaterally renegotiate each such agreement. And that is the reason MLI has come into picture. And that is the reason, in order to save time on bilateral negotiation and the procedures, we have adopted MLI as an instrument. So this slide only gives that the further, articles to this particular notification, which is forming part of India's position. And Article 1 only says that this convention, that is MLI, modifies all the covered tax agreements as defined. So all the list of the countries which India has deposited with OECD, all those treaties already gets notified by virtue of MLI. So now let us understand some of the important concept which is coming out of BEPS Action Report number 6, which is a mandatory standard, as I mentioned. So MLI Article 6 and Article 7 is the outcome of BEPS Action Report 6. MLI Article 6 deals with preamble. Now, what do you mean by preamble? Preamble defines what is the purpose of any particular tax treaty between the two countries. So preamble suggests how do we have to read and interpret that particular treaty. If we read the first paragraph, this was the existing preamble. So this is a preamble which is coming out of MLI Article 6, which is a BEPS Action Report number 15. It reads like this: intending to eliminate double taxation with respect to taxes covered by this agreement without creating opportunities for non-taxation or reduced taxation through tax evasion or avoidance. And in bracket, this is very important, including through treaty shopping arrangements aimed at obtaining reliefs provided in this agreement for the indirect benefit of the residents of third jurisdiction. Now, this is the MLI Article 6. And then if you see next paragraph, this reads what was the old preamble in the India-Ireland Treaty, which also continues to exist. So it reads like this: the government of Republic of India and Ireland, desiring to conclude a convention for the avoidance of double taxation and prevention of fiscal evasion with respect to taxes on income and capital gains, and with a view to promote economic cooperation between the two countries. So one of the objects for entering into India-Ireland Treaty was to promote economic cooperation between the two countries. And then by virtue of MLI, now the additional paragraph of preamble of MLI gets added to India-Ireland Treaty, which reads like this: intending to eliminate double taxation with respect to taxes covered by this convention without creating opportunities for non-taxation or reduced taxation through tax evasion or avoidance, including through treaty shopping arrangements aimed at obtaining reliefs provided in this convention for the indirect benefit of the residents of third jurisdiction. So as we can see, the exact paragraph of MLI Article 6 is now reproduced into synthesized text of India-Ireland Treaty. While synthesized text is not an official document, or I would say it is not a document which is legal or which can stand the eyes of the court. But nevertheless, when we read today's various synthesized texts, whatever amendments are applicable as per the MLI, those are reproduced as a box in the synthesized text of the respective documents. So why we are discussing this is that when we see the further slides on what were the facts of this case and the contentions of the SSC and what has been held by the tribunal, in that case, how do you interpret the object and purpose of the treaty in light of the preamble? So let us also read the basic provision, a very, very important provision, which is brought in by MLI, which is MLI Article 7, Principal Purpose Test. So again, as I said, this is a mandatory standard coming out of BEPS Section Report number 6. It reads like this: notwithstanding any provisions of a cover tax agreement, a benefit under the cover tax agreement shall not be granted in respect of an item of income or capital if it is reasonable to conclude, having regard to all relevant facts and circumstances, that obtaining that benefit was one of the principal purpose of any arrangement or transaction that resulted directly or indirectly in that benefit. So this is called as a reasonable purpose test, wherein you have to uh, prove the substance of the transaction, and wherein you have to prove that the reason for entering into transaction, the commercial reason outweighs the reason, that it was not your principal purpose to obtain tax benefit out of that treaty. And we will see some examples which are being referred by tribunal in this particular rulings from BEPS Section Report number 6, and how tribunal has given importance to those examples in order to derive that whether in this case on the merits of the facts whether principal purpose test is being satisfied or not. There is another carve out clause in the principal purpose test, and it reads like this: it is unless it is established that granting benefit in these circumstances would be in accordance with the object and purpose of the relevant provisions of the cover tax agreement. So what this carve out clause suggests is that if there is a treaty benefit that you are claiming, but if that treaty benefit was indeed intended to be granted by government of both the countries, and if that is in accordance with the object and purpose of that relevant treaty, in that case, a principal purpose test should not haunt you back, and you should still be allowed to be claiming the treaty benefits. So in this particular case, whether object and purpose test is being met or it is not met, okay, how tribunal has interpreted this, and what are our observations on this, that we will discuss in the ensuing slides. So Himanshu, may I ask to chip in over here and discuss the facts of this case and the observations?
Right. So, Monica, thank you for setting the context and providing this detailed overview about the MLI, because that's going to be something which we'll discuss at length as we proceed further. So now let's come to the facts of the case before the tribunal in this particular case. So this is a case where there was an Irish company which was part of a group known as TFDAC Group, an international aircraft leasing conglomerate. Sorry, I'm just getting some message on the screen. I hope I'm audible clearly.
Yes, Himanshu.
Okay. So in this case, the SSC was a part of a group known as TFDAC Group, which is a group engaged in international aircraft leasing business. This group comprised of 4 Irish entities, one holding company, one finance company, and 2 aircraft leasing companies. The group had leased 8 aircrafts to lessees in India, China, and Korea. And as far as India is concerned, the SSC had entered into 3 operating lease agreements with Indigo Airlines. Now, in light of these facts, the position that the taxpayer had taken in its tax return is to say that the lease rentals earned by it are not in the nature of royalty under Article 12 of the India-Ireland Treaty, given that under Article 12 of the treaty, which defines the term royalty, there is a specific carve out of aircraft from the definition of industrial, commercial, or scientific equipment. So what the treaty says that wherever any payment is made for the use of industrial, commercial, or scientific equipment other than aircraft, that shall be treated as royalty. So aircraft is specifically carved out from the definition of royalty. Basis that, the SSC's argument was the income earned by it is in the nature of business profits. And in the absence of a permanent establishment in India, those business profits cannot be liable to tax in India. It thereafter took a without prejudice argument to say that even if it was alleged to have a PE in India, having regard to Article 8 of the tax treaty, which specifically deals with income from, international operations involving aircrafts, the income would be exempt from tax. So these were the contentions of this was the position taken by the taxpayer in the tax return. Let's go to the next slide, please. Now, in the course of assessment, when the AO examined this matter, the AO made an allegation to say that the assessee has not satisfied the principal purpose test having regard to Article 6 and 7 of the MLI, and therefore it is not entitled to the benefits of the India-Ireland Treaty. Why did the AO so allege? The AO took note of the fact that the ultimate parent entity of the assessee was a Cayman Islands fund. Apart from that, the AO observed that the assessee's directors were holding positions in multiple other Irish companies. In this case, the directors were a firm of professional service provider which were providing services of acting as directors to multiple companies. And therefore, this was not a case of the assessee having its own directors, but was rather relying upon a professional services firms to provide services of directors. Apart from that, the AO observed that the day-to-day management of the company was again outsourced to a professional services firm by the name of Apex Group Limited, and certain lease management functions were contracted to a bank in London known as DVB Bank. When the matter traveled to the DRP confirmed the findings of the assessing officer and also reaffirmed the point that the assessee ought not to be entitled to the benefits of the tax treaty. In addition to the points referred to by the assessing officer, the DRP further made an observation to the effect that the assessee hardly had any infrastructure of its own or employees of its own, and therefore the assessee was not carrying on any genuine operating lease business from Ireland. As far as Irish professional expertise is concerned, the DRP observed that such an expertise could have been availed in any other jurisdiction. There is nothing peculiar about Ireland which gives credence to establishing operations in Ireland. Further, the DRP observed that the fact that the assessee had leased aircraft to some other jurisdictions also, that was not a relevant consideration for examining applicability of the PPT. Other than that, the DRP observed that assuming that the assessee is entitled to the benefits of tax treaty, the presence of aircraft in India leads to a fixed place P for the assessee in India, and also that this, according to the DRP, having regard to the terms of the lease agreement, this was not a case of operating lease, rather this was a case of finance lease, and therefore the income arising from finance lease ought to be taxed under the interest article of the tax treaty. So in essence, if we see what arises or culminates from the observations of the assessing officer and the DRP is that the assessee is not entitled to the benefit of tax treaty having regard to the principal purpose test on the ground that the assessee is an entity which has been established in Ireland without any substance and without any commercial rationale. And the main objective behind setting up this entity in Ireland was only to obtain the benefit of the India-Ireland tax treaty, and therefore the assessee's case falls foul of the principal purpose test or PPT under the treaty. So with these observations, let's look at the final order which was passed by the assessing officer. The assessing officer finally passed an order holding that the assessee is not entitled to the benefits of the India-Ireland Treaty and that the lease rental income earned by the assessee is in the nature of royalty income under section 916 of the Income Tax Act. on a without prejudice basis, the assessing officer further held that even if the assessee were to be entitled to the benefits of the tax treaty, the assessee has a fixed place P in India in the form of aircraft which was physically present in India. The AO further observed that Article 8 would not come into play out here because Article 8 applies only where there is a leasing activity involved with international traffic. And given the fact that this aircraft were leased to Indigo Airlines, which was primarily flying the aircraft within India rather than on international routes, Article 8 would not come into play. And there's a further allegation to the effect that in any case, the lease income would be a finance lease income. It is not operating lease, and therefore the case falls outside the purview of Article 12. It falls within the purview of interest article. So this is the nature of assessment order which got passed in this case. The matter thereafter traveled to the tribunal. And let's look at some of the key contentions of the assessee before the tribunal. Before the tribunal, the assessee relied on the decision of the Supreme Court in the case of Nestle, wherein it has been held that a notification under Section 90 of the Income Tax Act is a necessary and mandatory condition to give effect to a tax treaty or to any protocol which seeks to amend the tax treaty. So if you look at Section 90, Section 90 categorically says that while the government is empowered to enter into any international tax treaty, if effect has to be given to that tax treaty, a notification has to be issued under Section 90, giving life to that tax treaty. By virtue of that notification, the treaty will come into life. So that's what the Supreme Court observed in the case of Nestle. The assessee argued that in the present case, while the India-Ireland tax treaty itself was notified in 2002, and while the MLI was notified in 2019, there was no separate notification which was issued under Section 90 to incorporate the provisions of the PPT into the India-Ireland treaty, and hence the PPT cannot be moved. In a sense, what the assessee was trying to argue before the tribunal is that apart from notification of the treaty itself and apart from notification of MLI, there's a need for India to issue one more notification to say that Article 6 and 7 of the MLI now get incorporated into the India-Ireland Treaty. And in the absence of that third notification, Article 6 and 7 of the MLI cannot get incorporated into the India-Ireland Treaty. That was the contention of the assessee out here. Then on merits of the case, sorry, we are still on that slide. Monica, I'll tell you when to turn the slide, please. On merits of the case, the assessee argued that in any case, principal purpose test stands satisfied in this case, and PPT has been incorrectly invoked by the tax department having regard to the facts of its case. The assessee further contended that this is a case where it had entered into an operating lease and not a finance lease, and therefore its case would not fall within the interest article. It would be governed by the royalty article, and having regard to the specific carve out of aircraft lease income from royalty, the income would be in the nature of business income, and in the absence of PE, it would not be liable to tax in India. It further argued that even if it was to be assumed that there was a PE in India, its case would fall under Article 8 rather than Article 7, because Article 8 is a more specific article, and even on that ground, India would not have a right to tax this income. So these were all the contentions of the assessee before the tribunal. So now let's see what exactly has the tribunal held or adjudicated on this subject matter. As I mentioned earlier, the focus of today's session will be only on the first two aspects, which is number one, the applicability of MLI, and number two, the interpretation of PPT. We will not dwell into the aspects of operating lease versus finance lease and applicability of Article 7 versus Article 8 as far as today's session is concerned. So on the applicability of the decision of Supreme Court in the case of Nestle, what the tribunal observed is that In Nestle's case, the taxpayer sought to invoke the MFN clause contained in certain treaties so as to import more favorable provisions contained in certain subsequent treaties entered into by India with some OECD member states. So just to elaborate on that point, what had happened in the case of Nestle is that India had entered into a treaty with Switzerland and a few other similar countries which had an MFN clause. The MFN clause of the India-Switzerland Treaty provided that while the normal rate of tax on dividend income would be 10%, what the MFN clause provided is that if India enters into a treaty subsequently with any OECD member state and agrees to a rate of tax on dividend at a rate lower than 10%, then that rate will equally apply to dividend article under the India-Switzerland Treaty. Now, what had happened in this case was that after India entered into treaty with Switzerland, it entered into treaties with Slovenia, Colombia, and Lithuania. At the time when it entered into treaties with these three countries, they were not OECD member states, but they became OECD member states at a later stage. And under the tax treaties between India and Slovenia, Colombia, and Lithuania, India agreed to a rate of tax of 5% on taxation of dividends. And therefore, the assessee's contention in Nestle's case was that having regard to the MFN clause under the India-Switzerland Treaty and having regard to India entering into subsequent treaty with OECD member states, that 5% tax rate should automatically get incorporated into the India-Switzerland tax treaty as well. The contention of the revenue before the Supreme Court was that no, this is not how it works. If the benefit which India has agreed to, the benefit of lower rate of tax under tax treaties with Colombia, Lithuania, or Slovenia, if that benefit has to be incorporated into the India-Switzerland Treaty, it would be necessary for India to issue a specific notification to that effect under Section 90, subsection 1 of the Income Tax Act. The Supreme Court agreed with the contentions of the revenue, and the Supreme Court observed that a notification under Section 90, subsection 1 is necessary to give effect to a tax treaty or any protocol to the tax treaty which seeks to amend the terms of a tax treaty. The Supreme Court further observed that a MFN benefit cannot be automatically imported into another tax treaty. A benefit which has been given to a third country has to be notified in the earlier DTA as a consequential amendment. In other words, what the Supreme Court held was that the benefit which India has agreed to in its tax treaty with Slovenia, Colombia, and Lithuania, that benefit, for it to get incorporated into the India-Switzerland tax treaty, a specific notification should have been issued by India under Section 90, subsection 1, which India did not issue. And in the absence of that notification, that benefit cannot get imported into the India-Switzerland Treaty. Now, to further support this contention, the Supreme Court made an observation that historically, if we see, whenever India enters into an MFN clause, to give life to that MFN clause, India has actually been issuing such notifications under Section 90, subsection 1. And this has been an established practice of India. And the Supreme Court observed that prevailing practices are relevant for interpreting tax treaties. So it has been an established practice that if India is agreeable to give that MFN benefit, it generally issues such notifications under Section 90, subsection 1. But no such notification was issued under the India-Switzerland tax treaty. And therefore, even in terms of the established practice, the benefit of lower rate of tax of 5% on dividends under India's treaties with Slovenia, Colombia, Lithuania cannot be made available under the India-Switzerland tax treaty. So this is what essentially the Supreme Court held. Now, there was a review petition which was filed against the decision of Supreme Court in the case of Nestle, which was rejected by the Supreme Court a few months back. Further, a curative petition was also filed after the dismissal of the review petition, and that curative petition also has been dismissed by the Supreme Court now, just a couple of days back. So that is where we stand on the Nestle decision. Now let's see, how does the tribunal apply the Nestle decision in the facts of the present case, which is the case of Sky High. In the case of Sky High, what the tribunal has observed is that the Nestle Square case squarely applies in the present case as well. The tribunal observed that the India-Ireland Treaty was notified in the year 2002. Further, the MLI and the MLI, which also includes within its purview the India-Ireland Tax Treaty, was also notified by India in 2019. However, the tribunal observes that the consequence or the impact of the MLI on the India-Ireland Treaty has not been separately notified. The tribunal observed that the modification of an existing tax treaty can be enforced only where a specific notification under Section 90 subsection 1 has been issued by India, and unless the changes contemplated in the MLI are expressly incorporated into an existing tax treaty through a notification under Section 90 subsection 1, those changes cannot operate. And having regard to the fact that Article 6 and 7 of the MLI have not been specifically notified by issuing a notification under Section 90 subsection 1, those articles of the MLI cannot get incorporated into the India-Ireland Treaty, and therefore PPT cannot be invoked by the department against the assessee in this case. So essentially what the tribunal said is that the notification of the treaty and notification of MLI in itself is not sufficient. What India was also required to do is specifically issue a notification under Section 90 subsection 1 to say that by virtue of MLI, Article 6 and 7 of the MLI now also get incorporated into the India-Ireland Treaty, and this will be the impact of Article 6 and 7 going forward. That is the interpretation of the tribunal on the decision of the Supreme Court in the case of Nestle. Now, the moot question which comes up for consideration is whether the tribunal has correctly applied the Nestle principle in the facts of the present case or not. We would like to believe that the conclusion of the tribunal seems to be very, very debatable. In our view, the decision of the Supreme Court is distinguishable as far as this particular case is concerned. The Supreme Court case, in the case of Nestle, dealt with the scenario of India having a treaty with one country, we'll call it country A, which had a MFN clause. Thereafter, India entered into treaty with another country, say country B, wherein it gave some benefits. And what the Supreme Court held was that if the benefit given under treaty between India and country B have to be made available under the treaty between India and country A specific notification should have been issued to that effect. Whereas if we look at the facts of the present case, in the case of Sky High, there's only one treaty which is involved here, which is the India-Ireland Treaty. The India-Ireland Treaty has been already notified under Section 90 subsection 1 in 2002. The MLI which seeks to modify the India-Ireland Treaty has also been notified in 2019, and therefore prima facie it would appear that the requirement to issue one more notification to say that this is how Article 6 and 7 of the MLI will impact the existing India-Ireland Treaty, to our mind seems to be somewhat unwarranted, and therefore to that extent this decision seems to be a highly debatable as far as this aspect of the decision is concerned. I guess the tribunal itself may have also realized that the conclusion that it has come to is somewhat highly debatable, and that is why after making all these observations and after holding that PPT cannot be invoked against the assessee in the facts of the present case, the tribunal went on further to actually examine whether PPT can apply in the facts of the present case or not. So let's move on further. So on a without prejudice basis, the tribunal, can you go to slide 20 here? On a without prejudice basis, the tribunal now went on further to examine the facts of the assessee's case and whether in the facts of the assessee's case, whether PPT can be invoked or not. And the tribunal took note of some very important facts. The tribunal observed that in this case, the assessee holds a valid tax residency certificate or TRC, which has been issued by the Irish authorities. Apart from that, the assessee is a part of TFDAC group, which consists of 4 Irish companies. As I mentioned earlier, within these 4 companies, there was one holding company, there's one finance company, and 2 aircraft leasing companies. The tribunal observed that the assessees group had leased aircrafts to different lessees across India, China, and Korea. And these aircraft leases, especially the aircraft leases which were given to the Indian airline, which is Indigo, these leases were executed prior to introduction of MLI into the tax treaty. It went on to further observe that there was enough and more commercial justification or rationale for the assessee to set up its operations in Ireland. And that is because Ireland is home to 19 of the 20 largest lessors in the world, and 60% of the world's global leasing income is derived in Ireland, and global leasing operations rather are carried on from Ireland. The tribunal observed that Ireland has established itself to have an aviation expertise and a deep knowledge pool in this particular sector, and the strategic location of Ireland serves as a gateway between Europe and North America. Coming to the specific facts of the assessee, the ITAT observed that in the facts of this case, the directors of the assessee, its bankers, and its company secretary were all Irish. Further, the assessee was managed by a management service provider in Ireland to undertake its day-to-day operations. So, in all, what emerges from this is that, as per the tribunal, the assessee was carrying on significant operations from Ireland. It was an entity with substance in Ireland, and there was a strong commercial rationale for it to set up its aircraft leasing operations in Ireland. With these observations, let's move on to the next slide to see what have been the findings of the tribunal in the facts of this case. First and foremost, the tribunal dwelled upon the relevance to be given to the tax residency certificate. The ITAT relied on the landmark decision of the Supreme Court in the case of Azadi Bachao Andolan, wherein it was held that TRC is conclusive proof of residence of the taxpayer. The tribunal further observed that it is inconceivable that Irish tax authorities are not familiar with the concept of PPT, and they have blindly issued the TRC without any application of mind. And therefore, the tribunal observed that TRC will be presumed to be a valid ground for allowing the treaty benefits even after notification of the MLI. So this is a very, very far-reaching observation or statement being made by the tribunal to say that once the taxpayer produces a TRC, that by itself is good enough, and just basis the TRC, principal purpose test cannot be invoked by the department at all. Now, to my mind, again, this is a very, very far-reaching observation of the tribunal. I think the tribunal did not appreciate the fact that both the TRC and PPT, they operate in completely different spheres. What does the TRC seek to achieve? The TRC essentially seeks to substantiate that a taxpayer is a tax resident of Ireland. And how does a taxpayer become a tax resident of Ireland? If it is liable to pay tax on its income in Ireland, it is regarded as a tax resident of Ireland, which enables it to obtain a TRC. What does the principal purpose tax test seek to do? PPT seeks to deny the treaty benefit if the taxpayer has entered into a transaction or an arrangement, one of the principal purposes of which is to obtain a treaty benefit. Therefore, one would appreciate that TRC has nothing to do whatsoever with applicability of PPT. In other words, if a taxpayer proposes to claim the benefit of tax treaty, it has to cross 2 hurdles. It has to cross the hurdle of TRC. It also needs to cross the hurdle of PPT. And it may not be appropriate to say that just because the assessee has a TRC available by itself, that is good enough for it to argue that basis the TRC, PPT is deemed to be satisfied. And sorry, PPT is deemed not to be satisfied, and therefore PPT cannot be invoked in this particular case. And if we follow the view of the tribunal, then virtually the principal purpose test will almost become redundant in most of the cases or most of the transaction or arrangements which taxpayers may have entered into. And therefore, I think it'll be good for us to take this observation of tribunal with a pinch of salt. Now, moving on further, having made this observation that PPT cannot be invoked because the assessee had already produced TRC, the tribunal went on further to examine the applicability of PPT in the facts of the present case. And therefore, the tribunal placed heavy reliance on OECD's BEPS Action Plan 6 report to interpret the provisions of PPT. How exactly should one go about interpreting the provisions of PPT? What is the scope and purview of PPT? In which scenario should PPT be invoked? And in which scenario should PPT not be invoked by the revenue? For this purpose, the tribunal relied on certain examples which have been given in OECD's BEPS Action Plan 6 report. Let's first look at these examples on the next slide and then we'll come back to this slide. Can you move this? So the tribunal referred to one particular example, example C of this Action Plan 6 report. This is a case where there was a company known as ARCO, which was a resident of state R. This company was in the business of producing electronic devices and its business was rapidly expanding globally. And therefore, ARCO was considering to establish a manufacturing plant in a developing country in order to benefit from the lower manufacturing costs in such developing country. ARCO then did a preliminary review and identified 3 different countries which meet its requirements. And ARCO came to the conclusion that it can well carry on operations of setting up the plant and making investments in any of these 3 locations from an economic and political standpoint. However, ARCO realized that out of these 3 countries, State S is the only country which has a favorable tax treaty with State R, and therefore ARCO decided to set up its manufacturing plant in State S. And the question is whether PPT can be invoked in this case on the ground that one of the principal purposes of making investment in State S was to claim the benefit of tax treaty between State R and State S. And what has been observed in the BEPS Action Plan report to this effect is that according to the OECD, in this case, PPT cannot be invoked. The reason being that the principal purpose for building the plant is for expansion of ARCO's business globally and to avail of the lower manufacturing cost in State S. And it cannot be considered that one of the principal purposes for setting up the plant is to obtain the benefit of treaty between R and S. While of course, that may be one of the ancillary advantages of setting up operations in State S, which is the lower rate of tax under the tax treaty. That was not one of the principal purposes to make investment in State S. Other than that, the tribunal observed that if we look at the object and purpose carve out from the definition of PPT, what Monica referred to earlier, the OECD in BEPS Action Plan 6 also observes that given that a general objective of tax conventions is to encourage cross-border investment, obtaining the benefit of State R State S convention for the investment of plant in State S is in accordance with the object and purpose of the provision of that convention, and even on that ground, PPT should not apply. So PPT should not apply on 2 counts. Number 1, the principal purpose of this investment was not to obtain the benefit of tax treaty. And number 2, in any case, this investment is in accordance with the object and purpose of treaty, which also takes the case out of the purview of PPT. Let's look at the next example which the tribunal referred to in its decision. This is a case where we have a company TCO, which was incorporated in state T. TCO had subsidiaries in country X, Y, Z, and Q. But TCO did not have any favorable tax treaty with any of these countries. So what TCO did was to set up a regional company in state R known as RCO, and RCO decided to provide certain intra-group services in the form of accounting service, legal service, HR services, finance, treasury service to all the group companies. And in the facts of this case, it has been mentioned that the decision to set up operations in state R was basis the availability of skilled labor, reliable legal system, business-friendly environment, political stability, and sophisticated banking system in state R, and also, of course, taking into account the fact that state R had a comprehensive tax treaty network with all the countries where its subsidiaries were located. Again, on these facts, the OECD recommendation is that PPT ought not to apply. This is provided ARCO undertakes significant functions, owns significant assets, and undertakes significant risks for carrying on its business operations in state R through its own personnel. So, in other words, what the OECD says is that even if one of the principal purposes, or even if one of the purposes of setting up operations in state R would have been to claim the benefit of treaties between state R and state X, Y, Z, and Q, given the fact that actual genuine operations are being carried out from state R, actual services are being provided by state from state R, on that count itself PPT cannot apply. So having referred to these two examples, let's come back to slide 22 to see how does the ITAT then interpret PPT in the facts of our case. So the ITAT observed that even where a jurisdiction is chosen partly because of its treaty network, treaty benefits cannot be denied where substantive economic activities are carried on and real business risks are assumed in that jurisdiction. So as we saw in both the earlier examples, in example number 1, substantial operations in the form of setting up a plant was carried out in state S. In the next example, substantial economic activities in the form of genuine provision of intra-group services was being carried out in state R. And therefore, where substantive activities are undertaken and business risks are assumed in a particular jurisdiction, PPT cannot be invoked in such cases. The tribunal observed that similarly, in cases where the assessee proposes to undertake significant business expansion in a particular country or establish operations in a particular country for operational efficiency or to access resources, qualified resources that may be available in those countries, these will all be factors to negate the applicability of PPT. And the tribunal further observed that PPT cannot be read so broadly to imply that treaty benefits must automatically be denied in every case where the ultimate parent entity is a resident of third country. So what emerges from all these observations is that if a taxpayer sets up operations in a particular country, and if the taxpayer has enough and more commercial rationale for setting up operations in that country, and if it has substance in that country, and if it carries on genuine activities from that particular country and assumes business risks from that country, then in such cases it may not be appropriate to argue that one of the principal purposes of setting up operations in that country was to obtain the benefit of tax treaty and therefore invoke the PPT. So with these observations, let's see how does the tribunal apply these observations in the facts of our case. We move to the slide number 25 now. Now, one of the main contentions of the revenue before the department was that the assessee's ultimate parent was in Cayman Island. It was a Cayman fund. And this fund just set up an SPV in Ireland to claim the benefit of India-Ireland tax treaty. And on that ground itself, PPT should be invoked to deny that benefit. The tribunal observed that just because a taxpayer sets up an SPV in a tax favorable jurisdiction that by itself cannot be a ground to invoke PPT. And for this purpose, tribunal heavily relied on the landmark decision of the Supreme Court in the case of Vodafone International Holdings and also the decision of Bombay High Court in the case of bid services. In both of those cases where the courts have given weightage and credence to the fact of establishing SPVs by MNCs for the purpose of, say, operational efficiency or tax planning or risk mitigation or for any other purpose whatsoever. So mere setting up of SPV by itself cannot mean that PPT can be invoked in such cases to deny the benefit of the treaty. That was the first important observation. One of the important contentions of the revenue is that this SPV is a shell entity because it does not have any employees. And on that count, again, the benefit of treaty should be denied. On that aspect, the ITT observed that it is not necessary for every SPV to have employees. Appointment of independent management service providers is also something recognized under the Indian tax law. And in this case, the assessee was managed by a professional services firm known as Apex Group, which is as such based in Ireland. And apart from that, the directors of the assessee, the bankers, company secretary, legal advisors were all residents of Ireland. The tribunal further observed that the assessee was carrying on substantive commercial operations from Ireland. It was incurring genuine business expenditure from Ireland, and it also assumed significant economic risks in Ireland. And then the tribunal observed that presence of a favorable tax treaty, when coupled with real commercial substance, does not trigger the anti-abuse consequences of PPT. To further lend support to this argument, the tribunal observed that this was not a case where the assessee had established operations in Ireland just to claim the benefit of India-Ireland Treaty. It had established operations in Ireland to undertake global aircraft leasing operations. And apart from India, aircrafts were leased to other jurisdictions as well. And it also made one very interesting observation, and that is that similar to the benefit available under the India-Ireland Treaty, there is an identical benefit available under the India-Israel Treaty, India-Sweden Treaty, India-Greece Treaty, and India-Netherlands Treaty also. And if the objective merely was to claim the benefit of tax treaty and not offer the aircraft lease rental income to tax India, the assessee may well have set up operations in any of these countries. But despite that, it decided to set up operations in Ireland primarily because of the strong aviation ecosystem which is prevalent in Ireland and also the strong leasing infrastructure in Ireland. So in essence, what the tribunal has observed in the facts of this case is that the taxpayer in this case undertook significant operations in Ireland. It had enough and more substance in Ireland, and there was a strong commercial rationale for it to set up operations in Ireland and undertake the aircraft leasing operations from Ireland. And as a result of all these factors, it cannot be said that one of the principal purposes of the benefit under one of the principal purposes of setting up operations in Ireland was to claim the benefit under the India-Ireland Treaty, and on that ground, PPT cannot be invoked. Having said that, there's one more reason or justification which the tribunal provided as to why PPT cannot be invoked. Monica, if we can go back to that slide which defines the term PPT under the India-Ireland Treaty, slide number 8 or 9. Yeah, sorry, this 12, yeah. So let's look at the principal purpose test under the India-Ireland Treaty. What the PPT says is that notwithstanding provisions of a treaty, notwithstanding any other provisions of the treaty, a benefit under a covered tax agreement shall not be granted if it is reasonable to conclude that obtaining that benefit was one of the principal purposes of any arrangement or transaction that resulted directly or indirectly in that benefit, unless it is established that granting the benefit in these circumstances would be in accordance with the object and purpose of the relevant provisions of the covered tax agreement. So even if one of the principal purposes of any arrangement was to claim the benefit of the tax treaty, if the assessee can substantiate that this benefit being claimed is in accordance with the object and purpose of the treaty, even on that ground, PPT cannot apply. So having observed this, let's see what the tribunal has to say on the subject matter. So the ITAT then placed emphasis on the object and purpose of the treaty. And to understand this expression as to what exactly do we mean by the object and purpose of treaty, the ITAT once again referred to an example number E of the BEPS Action Plan 6 report, which is on the next slide. Let's move to that. Let's have a look at this example. So this is a case where a company RCO in state R was having 24% stake in a company in state as ESCO. Now, there was no tax treaty at that point in time when ARCO was holding this 24% stake in ESCO. However, at a later stage, a tax treaty got entered into between the two countries. And what the tax treaty provided for is that in case ARCO holds minimum 25% stake in ESCO, then it will be eligible for a lower rate of tax on dividend income. And to avail of that benefit, ARCO actually increased its stake from 24 to 25%. And the question which was examined was whether PPT can be invoked in such case, because one of the principal purposes of the assessee to enhance the stake from 24 to 25% was to avail of the lower rate of tax on dividend clearly. And the analysis which has been done by OECD is to say that clearly one of the principal purposes for the transaction is to obtain the benefit of lower withholding tax rate on dividend. One can't deny that at all. Having said that, as we mentioned earlier, granting the benefit under this article is permitted to a taxpayer who genuinely increases its participation in a company in order to satisfy the threshold of 25% which has been set up under the treaty. And that PPT would not apply since granting the benefit would be in accordance with the object and purpose of Article 10, which is to promote cross-border investments. So even if one of the principal purposes of the transaction was to avail the benefit of the treaty, because this investment was made to further the object and purpose of the treaty, which is to promote cross-border investment, on that ground also PPT cannot be invoked. So let's go back to slide 26 now. So having referred to this example, what the ITAT observed in this particular case, in the case of the assessee, is that the very object and purpose of the India-Ireland Treaty is to exclude aircraft leasing income from its purview, to exclude that income, of course, from source-based taxation. And when a taxpayer claims the benefit of such tax treaty, it is not seeking to subvert or misuse the provisions of the tax treaty. It is actually availing a benefit that the treaty intends to grant. The treaty specifically intends to grant that benefit, and therefore, if I claim that benefit, that has to be in accordance with the object and purpose of the treaty, and on that ground also PPT cannot be invoked. So the tribunal gives two justifications why PPT cannot be invoked in the facts of this case. Number one, there was a strong commercial rationale for the assessee to set up operations in Ireland, and it was not one of the principal purposes to set up operations in Ireland to claim the benefit of India-Ireland Treaty. And number two, in any case, whatever benefit it claimed was in accordance with the object and purpose of the treaty. Having said that, it's also important for us to look at the preamble to the tax treaty, because apart from this example E of BEPS Action Plan 6, the object and purpose of any tax treaty is to be found in its preamble. So let's go back to the preamble of the India-Ireland Treaty, please. So I'm reading the portion which is in the blue box. The preamble to the India-Ireland Treaty, as has been amended by MLI, says that the intention is to eliminate double taxation with respect to taxes covered by this convention without creating opportunities for non-taxation or reduced taxation through tax evasion or tax avoidance, including through treaty shopping arrangements aimed at obtaining reliefs provided in this convention for the indirect benefit of residents of the third jurisdiction. And therefore, it will be of paramount importance to keep the preamble also in mind. And why do I say so? Let's look at the OECD commentary on the importance of preamble. And why is this so important in every case of treaty interpretation? So having referred to the preamble, let's see what does the BEPS Action Plan Report 6 have to say on the importance of the preamble. It says that since the title and preamble form part of the context of the convention and constitute a general statement of the object and purpose of the convention, they should play an important role in the interpretation of the provisions of the convention. According to the general rule of treaty interpretation contained in Article 31 of the Vienna Convention, a treaty shall be interpreted in good faith in accordance with the ordinary meaning to be given to the terms of the treaty in their context and in the light of its object and purpose. So very clearly, a treaty has to be interpreted in light of its object and purpose. And the object and purpose of the treaty is to be found in the preamble. So while in a case where there is a genuine tax resident of Ireland which seeks to claim the benefit of the India-Ireland Treaty, obviously it ought to be entitled to the benefits of that tax treaty. Obviously, PPT should not be invoked in such cases. At the same time, we need to keep in mind that if it's a resident of a third country which is merely going to route its investment through a tax favorable jurisdiction, say for example in Ireland by just setting up a shell entity in Ireland and then undertake operations from Ireland to claim the benefit of India-Ireland Treaty, the revenue may then invoke the provisions of the provisions of preamble other than PPT. The revenue could then rely on the provisions of preamble to say that clearly the treaty benefit, the objective of the treaty is not to grant benefit to residents of a third country who indirectly seek the benefit under the tax treaty between India and Ireland. Now, unfortunately for the revenue in this case, the revenue has not based its arguments or detailed the arguments basis the preamble to the treaty itself. Their entire thrust of the argument was only based on PPT. Had they relied on the preamble also, they could have further canvassed their case to a certain extent. So we just need to be mindful of the preamble. Apart from the fact that we need to fulfill the conditions of PPT to avail treaty benefit, we will also need to satisfy the preamble to the tax treaty to claim the benefits of the tax treaty. So all in all, a very, very interesting ruling being pronounced by the tribunal on the subject matter is likely to have far-reaching implications going forward. First and foremost, as to whether the Nestle decision has been correctly applied in these facts is going to be a subject matter of significant controversy as this matter then travels to the High Court and maybe eventually to the Supreme Court at some day in time. Number two, on how does one interpret the principal purpose test of the treaty, there is very strong guidance even in this ITAT as to how is PPT to be interpreted, how is the object and purpose clause of the treaty to be implemented, how is the principal purpose of a treaty to be interpreted. And I think we should be able to rely on all this guidance provided by the tribunal in other cases as well. So with that, I come to an end of what we had to present today. Can check with the organizers if there is time available for any Q&A, and if anybody has any questions, I will take them.
Thank you, Monica. I think we should take a few questions for the next 5-10 minutes.
There are a few questions in the Q&A box and chat box.
Yeah, let's have a look at those. Okay, so there's comment from Sanjeev Chaudhary. Hi Sanjeev, good evening, how are you? Sanjeev has mentioned that we need to see the ratio of the Supreme Court judgment in Nestle's case. It is the ratio of the judgment which needs to be followed by all the courts, which I fully agree. Sorry. Sorry, was someone saying something? Okay. So yes, I fully agree. Of course, the ratio of Supreme Court judgment is binding on all the lower courts and lower authorities, no doubt about that. And rules of interpretation are important to follow, and I agree with you again. And can we say that the ITAT has not followed the ratio? In my mind, I think perhaps the case of Nestle is distinguishable, and perhaps that ratio has been incorrectly applied by the tribunal in this particular case. That's the way, that's our view on the subject matter. So that's as far as the Nestle decision is concerned. The second question is about the object and purpose of treaty. Whether the way it has been applied, would it restrict application of PPT in all cases if this test has to be applied independent of commercial? That's a very good question. As I mentioned earlier, the tribunal did rely on the object and purpose of the treaty. But as I mentioned earlier, one would also need to look at the preamble. And unless you have commercial substance, unless there is a commercial rationale for setting up operations in a particular jurisdiction, merely relying on object and purpose of the treaty, being to grant a treaty benefit by itself may not be adequate. And obviously, if you merely rooted your investment through a tax favorable jurisdiction without substance, without operations, then you could fall foul of PPT or the preamble as the case may be. Okay, there is one comment from Pushpak Shah. Can you provide a copy of the presentation? Yes, we will be happy to share the presentation. These are all the questions that I see in the chat box. I don't know if there are any other question. Okay, there's a Q&A box as well. Let's see the questions in the Q&A box. What is the difference between an amendment and modification to the tax treaty? Monica, would you want to take up this question, please?
Sure. So, as I was explaining, there are 4 types of compatibility clauses. What it tries to do is that because this is a single MLI instrument which modifies various treaties, so say there are, okay, let us take example of 1 or 2 compatibility clause. Okay, one says that you have to give effect to MLI provisions if such provisions are not there at all in the existing tax treaty. So if a particular provision is completely absent in existing treaty, then MLI provisions will come into picture. There is another kind of compatibility clause which says that if there is an existing provision, only then you can apply MLI provision. So, which means that say there is an existing provision on dividend article. Now, existing tax treaty do not specify any threshold of you holding a shareholder holding investment in a particular company for say 365 days in order to be eligible for concessional tax rate of dividend under a particular treaty. But after MLI coming into picture, where MLI brings in the threshold test, if India and opposite countries both have agreed to MLI article number 8, in that case, even though there was no threshold in the existing treaty, but by virtue of MLI and both countries agreeing to that provision, now we have to read that particular threshold test. So I hope I am able to explain you. I mean, your question is little vague, but with this example, you may be able to appreciate that how the existing treaty gets modified by the provisions of MLI.
Thank you, Monica. Let's move on to the next question. Next question is in the context of the wordings of section 90 subsection 1. So it says that 90 subsection 1 requires that a notification may be issued for making such provisions as are necessary for implementation of the DTAA or tax treaty. Whereas if you look at section 90A subsection 2, the requirement is to notify the agreement itself. Do you see that 90A subsection 2 is more substantive than 90 subsection 1? We don't look at it that way. In our view, if a particular tax treaty benefit has to be availed by a taxpayer, notification under section 90 subsection 1 is necessary, while the wordings used in the section are that the central government may by notification notify the treaty. Unless that notification is issued, the treaty cannot come to life. So I don't see much difference emerging as a result of the language of 91 versus 90A subsection 2, and that aspect is also borne out from the Supreme Court decision in the case of Azadi Bachao, wherein the Supreme Court has categorically said that for a treaty to come to life, notification under section 90 subsection 1 is mandatory. Okay, the next question is again with reference to Azadi Bachao Andolan. In Azadi Bachao Andolan, also the promotion of economic investment and economic interest was one of the aspects examined while granting benefit of a treaty. Absolutely, yes, you're right. That clearly is one of the objectives of the tax treaty, which one cannot deny. But we also need to be mindful of the current preamble to the treaty after its modification by virtue of MLI. So the current preamble says that not only is the objective to promote cross-border trade and economic interest between two countries, But the objective of the treaty is also to avoid treaty shopping arrangement, which was not present in the preamble which Supreme Court was concerned with in Azadi Bachao, and therefore the Supreme Court obviously did not have an occasion to examine that particular aspect. So with this, I think I've covered all the questions.
Himanshu, there is
There
one
is one.
participant who said, "Can he have an access to mic?" If you are okay, can I just
Yeah, sure, sure.
So I have
okay,
I have
Chaitanya?
unmuted Weber. I have unmuted
Okay,
Weber.
Vaibhav, can you go ahead, please?
Yes, yes, please, Weber. Yes, Weber, please speak.
Hello.
Hi.
Yes, Weber.
Oh yeah.
Hi.
Thank you so much. Thank you so much for this opportunity. So actually, I was wondering two things. Firstly, as Nestle lays down that we need a separate notification which will notify the effects, the changed effects of a particular tax treaty to basically allow any non-resident to claim that effect, right?
Yes.
Now, so suppose we have a non-resident who wants to get the benefit of the MFN clauses. Now, as per the treaties therein, as per the theoretical framework out there, he can still claim that. But the tax authorities and the courts here, what they are saying is you cannot claim it because the authorities have not notified separately. Now, in such a circumstance, while legally it is sound under Section 90 that a notification is required, but don't you think economically and commercially this doesn't make sense because the non-resident would not have any other recourse? So, despite having an MFN clause therein attached to the treaty, the benefit of which the non-resident is trying to take, they cannot file a case against the authorities for a notification, and there is no other way but to have a notification such that they can claim the particular benefit. So even after having the theoretical framework in place, that is the MFN, they are still being devoid of any kind of a benefit. So, and then we also know that how Nestle ruling, although it was re-challenged in the Supreme Court, it has not been accepted. So what do you guys think is the recourse for this?
You're absolutely right. I fully agree. The Nestle ruling itself came as a big, big surprise to everybody, especially to taxpayers and professional services firms equally, and to the lawyers as well. And frankly, if you ask me, what is the recourse available? The assessee tried filing a review petition, which was rejected by the Supreme Court. Thereafter, a curative petition was filed that has also been rejected by the Supreme Court. And therefore, the only recourse available is now to make a plea before the CBDT to actually issue those notifications, which the Nestle decision refers to bring life to the MFN benefit. That's the only thing that we can do. And maybe, try and engage with our overseas counterparts. So the overseas governments, let them engage, the French government, the Swiss government. I think they'll have to engage with the Indian government and try and put pressure on India to actually issue those notifications so that MFN comes to life. Otherwise, MFN virtually will be a dead letter, which just doesn't make any sense at all. So I agree with you that this is the only recourse now available. Frankly, nothing much else can be done about it.
So, and taking this discussion on Nestle one step ahead, so I remember you were discussing the differences between the fact scenario of Nestle as well as the fact scenario of Sky High and how Nestle is between two treaties and it doesn't involve MLI. So when I was doing a bit of theoretical reading on MLI, I read that the entire purpose of the MLI is to negate a situation wherein countries are left to negotiate their own
Correct.
instruments to prevent treaty shopping, etc., etc. Right?
Right.
So, if that is the main purpose of the MLI, then don't you think the notification requirement breaches that particular essence of the MLI, wherein
Absolutely. Yeah, you're right.
so
I agree. Otherwise, the entire concept of MLI virtually becomes redundant, frankly.
exactly. So,
Absolutely.
like, so don't you think like that is another difference? If I was correct, if that is the another difference, and this is why the entire scholarly debate should evolve against the Sky High appeal to actually give effect to the very essence of MLI.
That obviously will be the argument of the revenue going forward before the higher appellate authorities or the courts, as the case may be. This point, I'm sure, will be argued at length by the revenue that if we take this position, then MLI virtually becomes redundant. Of course, the counter argument to that could be to say that who stops India from issuing that notification which the Sky High ruling has referred to. So you just issue that notification and MLI comes to life. It's not that MLI can never come to life. So it'll be interesting to see what view does the court take on this subject matter.
So,
Not only that, I think it
is the
also
appeal the
brings an
challenged?
imparity because Himanshu and Vaibhav, what happens is, let's say the changes are not operative in India, but it may be operative in the other country. So there's
I
going to be
agree.
an imparity as well that we need to keep
Correct.
in mind.
Correct. And that is why, we do believe that this decision is highly controversial and debatable. Let's see what do the higher courts have to say about it.
Okay, so is it so this is being challenged in front of the Bombay High Court as of now?
It will be a challenge, 100%. I have no
It
doubt
should
about
be.
it.
I mean, yeah,
It will
makes
be.
sense.
There's no way the revenue is going to leave it.
Okay, okay. Thank you, guys. It was an amazing session. Thank you.
Thank you.
Okay, then I think back to Chaitanya for the vote of thanks and closing, or Tanvi, whoever.
You're on mute, Chetan.
So thanks a lot. Very warm thanks and gratitude to both of you to come up during this hectic season and speak on this uh, judgment. So, which is very relevant in terms how the future of MLI looks in or is going in India. In fact, so this was very pertinent to have a discussion on this on such forums, sir. So thanks a lot for such in-depth analysis and making it more interactive, speaking and answering all the queries of the participants and all the and both of you have uh, enlightened us on this burning topic of international taxation. So thanks a lot on behalf of CTC, Himanshu sir and Monica.
Thank you.
So
Thank you. It was our
Thank you,
pleasure.
thank you.
Himanshu. Thank you,
And
thank you,
thank
Monica,
you.
for that
It's our
Thank you.
excellent
pleasure.
session. I request
Thank you,
everybody to
Chetan.
carry on with a loud virtual applause. Thank
Yes.
you, and we look forward to having
Thank
you
you.
more
Thank
in
you.
future on such
Thank
matters.
you.
We are,
Thank you, everyone, and wishing all the
Thank you.
yes.
participants a
Thank
very
you,
good
Shabir
evening.
Bhai, for the
Bye-bye.
moderation.
Most welcome.
Thank you.
Thank you, everyone. See
Yeah.
you.
You. Thank
Bye
you.
bye.
Bye.
Take care.
Thank you.
Bye-bye.
Bye-bye. Bye.
Bye.
Thank you, participants.